Hello, everyone. This is Tom Fox, and I'm absolutely thrilled today to have back with me, way overdue, is James Gellert. James, first of all, welcome back to the podcast, and thank you so much for taking the to visit with me today.
Yeah, thank you, Tom. I was trying to remember. I think this is our third or fourth time talking together like this, and I enjoy it every time.
I think I met you. I was trying to remember, but I think it was about 10 years ago at a conference where your company, Rapid Ratings, was one of the sponsors. And I learned about what you guys did. It was incredibly interesting to me because you were looking at third parties, supply chain and risk management in a way that frankly, not many people were looking at it back then. And Rapid Ratings has grown since that time. You evolved to a new role. So I wanted to maybe start with asking, what's your role today, or roles, I guess would be the better word?
Yeah, the company has evolved, and we all evolve with our companies as senior execs. I've had the pleasure of moving into a new role that is just the executive chairman role, and passed on the CEO baton to a gentleman named John DeLeo. And this has allowed me to spend more time talking about the company, speaking with clients, doing thought leadership and external communications, and being more heavily involved in helping to interpret the data of rapid ratings out to the broader community. I'm also spending time as the executive chair or the chair of the advisory board for a wonderful company called LogicSource, which also is in the supply chain space, but in a very different way. And LogicSource helps companies to manage the spend that they have with indirect suppliers and helps manage the indirect suppliers, which is an area where for many companies, there's historically a lot of inefficiencies and opportunities to both gain work and capital efficiency, but also just to have better, tighter, cleaner relationships with indirect suppliers. So I'm staying very much in supply chain and in broader risk and third party risk, but having a really good time these days.
James, I went back and looked, and we actually haven't visited on a podcast since COVID. And so the world has changed. The supply
It-
chain world changed, and risk management changed, or at least risks change. And so I wanted to maybe start with, hopefully I can call it the post-COVID world. What are some of the key things that you're seeing in the supply chain risk management space?
I think COVID in many ways accelerated a lot of the initiatives in supply chain that had been percolating for quite some time. Some companies were much more advanced and others were earlier in their processes. But the understanding of connectedness of risk and the importance of the members of a supply chain, particularly as you go deeper into the supply chain or more upstream in a supply chain. These are things that a lot of companies were doing pre-COVID, but COVID was a massive shock to the supply chain world to see just how much could be shut down and affected by even a small company that is your supplier, that you, as a risk management exec at a business, might not even know you're exposed to. But I think the greatest benefit or the biggest silver lining to the cloud of COVID is that more senior executives, more board members, more shareholders, and more people in supply chain and procurement have become truly focused on the need to manage suppliers and supply chain more actively and more collaboratively. And that the use of data and technology and strategies that hadn't been used before can be a part of really advancing supply chain risk for any eventuality. And certainly COVID was a bigger one than anyone had expected or had any experience dealing with.
I really appreciated your thought on acceleration, because the second most prescient thing I heard during the COVID year was we have accelerated 5 years into one. And the more I thought about it, it may be less or maybe more than 5 years, but you're absolutely right. We accelerated trends. And more importantly, we had to accelerate the response to those trends.
Yeah, that's right. In for many companies, it was in quarters 1 and 2 of 2020 that they had to identify what was happening, identify where the risks were emerging and what downstream from those activities or those actions would create more risk and more problems, and then find ways of remediating it, not just in a triage fashion, but in a systemic fashion. So the companies that identified problems and managed to solve them needed to solve the potential for those problems to happen again and create some type of organizational and structural change that would allow for the mitigating of those risks going forward or the preempting of those problems going forward. And we saw that in a lot of the ways that businesses reshored parts of their supply chain or diversified their supply chains offshore to be in different regions so they weren't taking concentrated risk from a country or a portion of a continent or a continent itself. And even just things like making sure that all parts weren't exposed to shipping and that where parts could be brought in by rail. These are things that are incredibly fundamental now that we look back at COVID and go, yeah, of course, if you can't get a ship across the world and into a port, you can't get any of the parts you need for X product. It's incredibly basic, but it was something that I think got lost in the expansion and the offshoring and the desire for companies to create more, in many ways, complex supply chains. And it was a real shock and it happened real fast. And the companies that could deal with that immediately did the best. And the companies that have put systems in place to be able to deal with it in the future are positioned to be better in the future than anyone else.
And that thought really leads to the most prescient thing I heard during the pandemic, which was we've moved from disaster recovery to business resiliency to business as usual. And it was those companies who could take and treat these events, particularly in probably Q2, as what can we do today to solve this problem, that were the ones who were able to not only come out of it, but plan for the future. Is that sort of business as usual concept really permeated folks you work with now?
Yeah, for sure. And you also hear the expression or the phrasing going from just in time to just in case, which I think is very similar to what you've just articulated. And the just in time, more efficient, lean supply chain and manufacturing philosophies did great until you couldn't get a part or you couldn't get a product of some kind. So the just in case is really about creating more redundancy, more resiliency without overdoing it. And so what does that actually mean? That's the process that most companies are trying to figure out. But in general, I would say that supply chains around the world are more sophisticated today than they were pre-COVID. There are more companies that are employing sophisticated means of identifying supply chain risks and have their organizations evolved to be able to handle them. Some more than others, and some are earlier in their journey. So we don't want to give everyone credit for being in perfect shape because they're certainly not. But there's more realization that there are problems to address than there was before COVID, even if they aren't actually fully addressing those problems yet.
I was in graduate school in 1980 and I worked for a professor, and I was sent to General Motors to interview about the concept of just in time, which was fairly revolutionary back then, at least for the automobile manufacturers. And we had that strategy literally for 40 years. And just in case moved us in a different direction. Was it was that trend ongoing pre-COVID and it got accelerated through COVID, or did companies have to make a huge pivot from your perspective?
We had to make a pretty big pivot. The automotive industry is an interesting one within global industries for supply chain risk because the large OEMs, the big manufacturers, have for years engaged more directly with their key suppliers than their counterparts in a lot of other industries, where there for many years was more of an arm's length relationship between the big company at the end of the supply chain and the suppliers going upstream. So in autos, there's been more communication not always great communication, but certainly communication and alignment of long-term product cycles and things like that. So if you're a brake manufacturer, you need to know what your biggest customers' plans are over the next 10 years for all kinds of elements of a car or a line in order to be aligning your brake manufacturing properly, right? So that communication has had to be really strong. But what we've also seen is that as an industry with EVs becoming a much bigger part of the auto industry, a lot of suppliers who weren't EV are now having to retool and create new process and create new products in order to be supplying to electric vehicles. And there are a lot of new suppliers. So the supply chain complexity has changed, and the risks that suppliers that have been in the industry for a long time, the risks that they carry are new and different because they're having to change a lot of the things that they provide. Um, but a common theme in autos, as well as lots and lots of other industries, is that there are a ton of private companies and smaller and middle market companies in those supply chains. And they carry a whole host of different risks than the large public companies. And in supply chain, you don't have to scratch the surface very far to get to a private company that is critical in your supply chain. Your first tier may be a public company, but they're buying from public and private companies, and they're buying from more private companies. And then you just have private companies. And roughly 75% of the Fortune 500's supply chains themselves are private companies. So everything that affects those businesses are going to be critical elements inside of a company's supply chain exposures. And autos is one of the sort of real stereotypical or real great examples of that type of supply chain and the risks that it endures.
James, going back to 2008 forward, at least up till 2020, we had an era, unprecedented era of very low inflation. I grew up at a time when we had very high inflation. So I've seen this go up and down, but truly from '08 to 20 was an extended era of low inflation. That has dramatically changed. So I wanted to maybe pivot to some of the current issues you are seeing because of, I hate to say inflationary era because I still laugh at 5%, but compared to 1, 2, or 0, I guess it is an era of inflation.
Yeah, I mean, inflation. It's funny talking about inflation right now because the numbers are big, right? Here in October of 24, inflation is more under control than it has been for the trailing X quarters. That being said, uh, costs go up a lot faster than they come down. And where inflation has hurt a lot of companies in supply chain is that the costs of goods, of course, is higher. The cost of labor is higher, and the cost of capital is higher, which is related to inflation, different, some different influences, but certainly related. But what this means is that the cost structures of a lot of companies, particularly middle market, smaller and private companies, have had a harder time because of their expenses have skyrocketed, but they can't necessarily pass all of those through to their customers. They try, but the bigger the customer, the more they can push back. And this has meant that a lot of the middle market has been strained by having their margins eroded and having a lot of pressures where they can only get a slightly higher cost for what they're selling, but they're paying materially higher for what they're buying. And that has caused a real problem in the middle market, which frankly really isn't talked about much. And I think the legacy of this period in time is going to be seen more over the next 24 to 36 months than it has been in this part that people talk about the most, which is we had a Fed stance with higher rates, and now we're seeing that tail off. We saw in higher inflation and the questions of whether we would have a soft landing or a hard landing, and it's looking softer. But none of that really matters to the companies that are being squeezed terribly in their operating profit and leverage and costs and so forth. And we're going to see those problems continue to hurt for a considerable period of time.
We have seen increased labor union activity, which has led to some contracts with very large salary raises for the labor union members. And while labor unions are a very small subset of the overall American economy in many ways, those negotiations lead the wage discussions across this country. So I wanted to maybe turn to labor costs as when coupled with inflation and the pressure that puts on suppliers and those in the supply chain.
I think it's part and parcel to the prior part of our conversation that companies are really suffering today from the increase in costs across the board. Labor, of course, is a particularly large one. And it's important to remember that for a lot of private companies that are small to mid-size, they are going to cut many things before they cut people. They're going to delay investments before they ask people to take pay cuts. They're going to do anything they can to not have to lay off staff. Some companies are great and great is maybe the wrong word. Some are more aggressive and proactive in reducing headcount when times are difficult, but that is usually a lagging indicator of how companies are managing themselves. So what all of that means is that for the typical company, they're going to be affected by these higher labor costs for a longer period of time. When we've seen union conflict with their industries, we would categorize that right now as potential supply chain disruption. It disrupts in lots of ways. But as we've just seen in the East Coast and the Southern port strike, which fortunately was short lived and is now delayed and will be revisited in January. Hopefully that is solved. And as we've seen with the longer Boeing strike, we've got two instances where union activity is actively involved in the work stoppage. And whether that's good or bad is a political discussion that we don't need to get into, but it has a long-term effect. And when you are slowing down any group of companies buying, you are dramatically affecting those they're buying from. And that means supply chain disruptions. When you combine that with our discussion about how much middle market and smaller and private companies have been affected over the last couple of years, it's piling on to those businesses when they can, generally speaking, least afford it, literally and figuratively.
James, if I could add the wrinkle of consumer spending in this era of inflation, and how do you see that adding yet another level of complexity?
It's pain on pain. As consumer spending, I think there are a lot of elements to consumer spending change, to the changes in consumer spending, but certainly the surge in spending that came from the liquidity injected in the market due to COVID response, government COVID response, that's burned off. And so we're seeing personal debt increasing. We're seeing delayed credit card payments. We're seeing those elements that are most easily tracked to understand whether consumer buying is changing and whether consumer sentiment is changing. The fact that in the so in 23 we had a spike in corporate bankruptcies. In 24 we are seeing a continued trend in corporate bankruptcies. The the companies that I think are interesting that are beginning to fail tend to be those that are whose businesses are driven by the more budget oriented consumer. It's the Red Lobsters. It's the Big Lots. It's the companies that are going to be affected most when those who are really being careful about where they spend are pulling back. And that's really telling that we have a changing consumer spending pattern and it is going to affect a lot of companies. Now, as interest rates begin to come back down, that will have some mollifying effect, but it doesn't change the fact that the people are spending less at the moment. And again, that is tied right back into inflation as well as liquidity.
James, how do you see this, or do you see this compression leading to more pressure up and down the supply chain?
We've seen the we've seen the a bifurcation between those companies that are the larger, generally speaking, public companies, and those that have bigger balance sheets, more access to capital, more ability to push price increases on on their customers, but the ability to spend less and to resist more price increases from their suppliers. We've seen a difference between them and the smaller companies, the middle market and the private companies. We've seen that for the last few years. When we look at things like operating profit of companies in the middle market operating profit has deteriorated close to 70% during this time, but net profit has declined 233% from the end of 2019 to the end of 23. And that trend is continuing during 24. Whereas we saw net profit for public companies during that time increase by just under 30%. That's a huge difference. And so again, that reinforces the fact that the larger companies are managing these times much more easily than smaller companies and private companies. When we look at things like leverage, the smaller companies have been borrowing significantly more. Leverage during that time is up almost 140%. Interest coverage is down a little over 70%. All of this paints a picture. And that picture is that the smaller companies in the middle market are going to have a much harder time rebounding from this. And we're going to see things shake out. That shakeout is going to be more bankruptcies, more mergers and acquisitions, more private equity acquisitions of companies, and more large companies having to buy material suppliers of theirs and incorporate them in. So it's a really interesting mix of things that will happen as this pitch continues.
James, you alluded to a little bit earlier when in 2020, when companies were scrambling around their supply chains, one of the things I heard from supply chain executives is they were speaking to the board, perhaps for the first time. Um, they were talking to the highest levels of the company because that was mission critical at that point in time. I'm going to use that to maybe introduce some of your work at LogicSource, because one of the things I saw on the LogicSource website said procurement as a service. And so I really wanted to explore, is that something, actually, I should say affirmatively, that's something I saw you talk about with Rapid Ratings in a way that I hadn't heard before. And is Logic Source maybe taking that to another level or to a different level, that concept as procurement as a service?
Yeah, I think it really is. And I appreciate that you see the commonality between these initiatives for me professionally, because to me, they seem quite consistent. And I've enjoyed this newer work that I'm doing with LogicSource because it is another approach to helping companies do better and be more efficient and have stronger supply chains. So there's real common themes. But I think what LogicSource is doing is helping companies to be more efficient at an area of supply chain management that historically has been less. So indirect suppliers, there are hundreds of categories of indirect suppliers, but there are things like your healthcare and your marketing and your facilities management and packaging and logistics and so on and so forth. And your typical company is just a little bit less efficient at managing those things than they may be at managing the parts and the commodities that are going directly into what you're building. And when you have the collection of, when you're acting as a service, a PEO, if you will, for lots and lots of companies, you see trend data, and trend data is incredibly important in this market. And when you've got billions and billions of spend that go through you like LogicSource does, and you can see who's being less efficient or more efficient in an individual category, you're able to help that company that's inefficient become more efficient. And that's I think an area where more businesses are bringing together the finance sides of their shops with the procurement and supply chain sides of their shops to look at how they can create more working capital and more working capital efficiency for their businesses by just being better at what they do. And LogicSource does a really phenomenal job of helping companies do that. You mentioned the boards, and I think we're in a period, and I do think it came a lot from COVID, where board members are asking more probing questions of supply chain and procurement and finance than they have in the past. And that's coming in large part because many of the public company board members, who of course typically sit on a lot of public company boards, they've encountered problems at one company and they've seen how those companies are improving the way they handle it. And then they come to their next board meeting for the next company and they ask the appropriate questions. And so you slowly get everyone getting a bit better and a bit more insightful into supply chain risk. The area that I don't see enough happening is shareholders, individual, retail, and institutional, asking at the quarterly shareholders meetings what the companies are actually doing about supply chain risk. They'll ask questions like, does this company have a lot of exposure to China, or does it have a lot of exposure to another area where there are plenty of areas with geopolitical risk these days, but area exposure to the Middle East? But they're not asking, what are you actually doing to manage supply chain risk better? What are you doing to look at financial health of suppliers? What are you doing to have better efficient management of your indirect suppliers? These are things that as the shareholder base, the equity base, and even bondholders get smarter and smarter, they need to be asking more of these questions of CEOs, CFOs, CIOs, and really pushing companies to be able to answer these questions. So I see all of this stuff happening at the same time. Boards are more engaged. Shareholders need to get more engaged. Senior management is getting more engaged, and they're doing that across a variety of things, whether it's the area that RapidRatings focuses on or the area that LogicSource focuses on. It's all part of the same.
James, unfortunately, we are near the end of our time for this episode. But before we leave, I wanted to ask you if any of our listeners wanted to connect with you, how might they be able to do so? And where could they go if they wanted more information on Rapid Ratings or LogicSource?
The websites for both rapidratings.com and logicsource.com. And I can be reached at Gellert at rapidratings.com and james.gellert at logicsource.com. But I'm very happy to be talking to any of your listeners about these subjects in more detail and or to connect them to the right people inside of both companies if there are aspects they'd like to dive into in even more detail.
James, I wanted to thank you again for taking the time to visit with me. It's been way too long.
It has, Tom. I appreciate it every time. I enjoy it.